Do you currently own a property? If you've had the property for a while, you more than likely have built up equity in your home. Did you know that you can unlock and access the equity in your home to help you achieve other goals that you may be considering? In today's episode, we are speaking with Walid Mutahar, mortgage agent with Garland Mortgages. Our focus is on how to access the equity in your property. This candid discussion was taken from our recent podcast. And to hear the entire conversation, you can check out our podcast on your favorite podcast player. The podcast is Realty Bytes Conversations on Real Estate and Lifestyle. It's season 1, episode 2. Check it out for more great information. I hope you enjoy today's video.
What are some of the ways in which a person can access the equity in their home?
Yeah, so the primary way is to deal with your mortgage professional, either your existing lender or a mortgage broker, to see if the lender will give you the money that you're looking for. So the process is generally the same. We're going to look at your income, your credit score. We're going to build a file. We're going to see, we're going to assess your needs, see exactly what it is that you're looking for. And we're going to try to determine if we can get that money out of your property, ideally with the same lender, because that will avoid any, breakage or any penalties of that nature. But it might make sense to also break in and take it to a new lender, because let's say your current mortgage at 5%, but another lender has a mortgage at 4%. The penalty is going to cost you $300. Well, that's a given. You're going to save that money back in a matter of months.
And so can you actually break down those payments, see the difference between keeping their existing lender versus moving to someone else and maybe paying the penalty?
Absolutely. Yeah. So that's kind of the legwork that we do. We're going to show you the hard numbers to show you if this even makes sense. Because of course, if it's not feasible, there better be a very good reason to take out that money. Because if there isn't, you're just going to end up paying for something you might not necessarily have needed to pay for.
So somebody has a home and they've lived there for a few years and they've built up some equity in their property. And you say to them, okay, we can now get you an additional, we'll take your example, $600,000, something that you want to do. So if they were to pull out that $600,000, that it means that they had to qualify for that amount, correct?
Correct.
So they're qualifying for the amount that they currently have on the mortgage plus the new amount.
Exactly.
If they were going to do it like that and just keep, or would they? Would they keep their existing mortgage and get second?
Yeah. So say you have a mortgage right now, you're in year 3 of a 5-year fixed. Okay. Penalty is huge. It might not make sense to break that mortgage. So what we would do is we'd go back to your existing lender, see if we can put a second mortgage in place with the same lender. And many of the big banks are great for this because they've developed what's called a collateral mortgage. So you're going to get a line of credit product for, let's say, $1 million, of which you have $500,000 existing as your current mortgage, and you need another $500,000. Well, we can add 2 loan segments within that $1 million line of credit. So it all remains in the first position. You're getting premium rates. You don't have to break anything. Now, it can be a logistical nightmare if you have too many of these segments. So, for instance, like one mortgage might come due, let's say it's 200. One mortgage might come due next year, one might come due 3 years from now, so on and so forth. But I mean, other than that headache, this is a very beneficial way of getting it done. If that's not an option, if your lender doesn't provide that option, then yeah, we would need to look at, you'll have your existing first mortgage, or put a second mortgage behind your first mortgage. And only a few institutional lenders do that, but a lot of private lenders will.
Right. And so that second mortgage would be at a higher rate.
Generally speaking, yes. Yeah. There are some banks that will go behind other lenders. For instance, if you have a First National first mortgage, TD Bank will actually go behind First National. So you can get a line of credit with TD, in which case the rate is going to be slightly higher, but it's not going to be as high as, a private lender would be.
Okay. And so how does the lender qualify you for this line of credit or this second mortgage? Is it how they would qualify you for in terms of a first position mortgage?
Exactly. That's exactly it. Ever since B17. That's when the new regulations stress test came out in November 2017. We're required to qualify you on the total lending amount. So even though your existing mortgage might be at 1%, the new mortgage that you're getting is at 5%, let's say, well, we actually have to qualify you for the whole amount on the stress test rate of the 5%, the new mortgage request. So it definitely is more difficult to qualify. It's not impossible, but given where rates are today, you might not be getting as much as you think you're getting.
So before you start looking, again, it's always best to be pre-approved, and you can obviously get pre-approved for a refinance or a line of credit, correct?
Correct. Yeah. The main difference being is we usually can't hold rates for refinances, but if we get the minimum documents needed, we could actually submit it to the lender, and that'll come as a rate hold once we have an active application on the system.